Hey traders, this is Scott Barkley. Hey, I just finished a great new video. As you know, I put short little videos up there to help you on your journey, and this one's especially great. But my goal is to turn your pains into gains. After all, I wrote the book, The Empowered Forex Trader, Turning Pains into Gains. So I'm going to get out of here and we'll get right into the video.
So that brings me to a point. The 240 is the chart where you determine the structure. All right. So we can look at this one right here and we can say, okay, the structure is down, MACD points down. I got a channel down. All right. So the structure is to the downside. All right. And are they making lower highs? They are making lower highs. Therefore, the structure is down. All right. See that? All right. Now, just because I have the structure on here, I need to know where the structure is trying to go. All right. So that's why you put the big fibs on from back here, and they'll show you immediately, yep, we're using them. What you want to find is the lines, the numbers that are important to the bankers, not to make pretty charts. All right. It's so that you can say, I know that the bankers know that line. I know they know that line. That means I know they know that line. I know that we're going to know this one. So en route, wherever the target is, that becomes a barrier or a bounce point. And because of that, that's the only place you move your stop. That's why you move your stop when you have a mathematical reason to do so. All right. So once you've got that all figured out, then you go down to the 60-minute chart where you live. This is where we live, and the bankers live here too. And now we're able to figure out from here what's left. Okay. What's left, if anything. All right. If I have 55 pips or more, I have an opportunity potentially. If I don't have 55 pips, I don't have one because it's a rule. Why is it a rule? Because the secret to being successful in the Forex is pressing your winners. And unless I have 55 pips, I don't have enough room, minimum, I don't have enough room to press my winners. All right. Which means I don't have a trade because I have to press my winners without exception. That means every single time. All right. And, in the beginning, when you're used to coming in, used to being a retail trader, just running in the market, grabbing 5, 8, 10 pips and jumping out, all right, then that's totally foreign to you. All right. That means you have to start using entry orders. Well, 85% of your trades need to be entry orders. 85%. All right. So how do I get to 85%? You start with the very next trade. That's how you get to them. Put the entry order on. All right. So you're looking for the wide open spaces. Wide open spaces. All right. So you can see that this pulls back, you'll then have this wide open space. All right. If it breaks through here, you'll have this wide open space, moving your stop here. All right. If you break in here, you'll have this little wide open space. See? All right. What tells you that? The chart tells you that. I can make a decision whether to trade it or not. All right. So I just need to know where the target is today. Well, that's pretty simple. We just pull up the ATR, and I want the pound New Zealand here, 140 pips. All right. So 140 pips, we find the 5 o'clock candle from yesterday. It's right in here, 1600, right up here. Oh, that's it right there. And we go down for 140 pips, 140. All right. See, now I know what's left of the trade. All right. So today, all that's left is this little bit. Do I have 55 pips? No, I don't. If they pull up to here, will I have 55 pips? Yeah, I will. All right. What did they do with the information on the break and the hook? You see what they did? Big candle. They entered. Why? Break, hook, break the barrier. We're in a wide open space. This is uncontested, and down they go. All right. We're looking for uncontested areas. All right, to trade in, and we're looking for the contested areas to move our stops. See? That makes sense? It's actually pretty simple if you think through the process. A market order is when you go over there and say, click me, take me in right now. That's a market order. An entry order is where you go figure it out. It's either a buy limit, sell limit, buy stop, or sell stop. All right. So a sell stop, right, is if you break this line right here, and let's say the target was down here. If you break that line, do you want to be in right there? If the answer is yes, you go in and you put a sell stop in your broker station for whatever that price is there and for how many lots you want on for that target. That's what you do. When a sell limit would be, okay, if this comes up to here like this and makes a turn, do I want to be in? I want to be in right there. So you put a sell limit in there, and if it hits that price, it takes you in instantaneously. Right? So you're not clicking it in, you're pre-programming your broker station to do the work. All right. And that's 85% of the time, Faye. See? So 85% of the time, that's what you're looking for. So if I'm looking for a pullback and I'm looking for a close in reverse, like that right there, I'm looking for a close in reverse. I would find where I find that top of that candle where it should stop, and then I place a sell limit for that trade right there. See, and you'll get it at the highest point. And why do I want to do that? It's because of risk and reward. All right. So remember, the decision to make a trade is based on reward for risk. All right. So if the currency were to come up here like this, here it is, and there would be the opportunity. If it were to come back up here, all right, draw it back up here, I would put a sell limit here because that's where they should come back to. Right now, if they hit my price, they take me in. But the reason I'm doing that is because there's going to be tens of thousands of traders who are going to do the exact same thing because bankers trade with entry orders. They figure it out. That's where we want to take it in. That's how when they pull it back, all of a sudden it takes off and goes down. Why? Because that's where they put their entry orders for the continuation. Everything in the Forex is about continuation until it's no longer about continuation. You're at the bottom or the top. Right? Then now they go the other way. Think about it this way. It's like football, rugby, anything like that. All right. There's a playing field. All right. Up at the top here is a goal. Down here is a goal. All right. If the Bulls who are running this way, if they score, the Bears get a chance to score. And this is what happens all day long. See there? Here's Thomas, 75, 59, 40, 21, minus 12, still in for the target. Nice job, Thomas. So there's an example right there. So Thomas is a fast tracker. You can see pressed his winners. He's got 5 positions in here, and he's still waiting for the target. All right. So 59 pips, 2 lots in there. That's 120. 75 pips on the first trade. That's 195. 40 on the second. That's 135. 235. 21. Add that, it's 247, and then take away 12 pips. Right? So he's already in and up 240 pips, folks. Almost what we did last week. And he's in one trade on a Monday. Crazy, huh? So there you go. So for newbies in here, the way you learn to do this is not me talking. It's not watching a video. It's you going into the charts and saying, I don't see break, hook, and goes. I don't see ABCs. I don't see what he's talking about, right? And so you decide which one of those you want to work on, because you need to work on them all sooner or later, and you start the process. Okay, so I don't see break, hook, and goes. Okay, go down to a 10-minute chart, find all the breakouts, and look for the break, hook, and go, and keep a track of it. All right. So it's very important that you keep track of it because you need to know the statistical. You can make this real simple, right? Just one big old pad of paper right here. All right, here they are. He's doing Fibonacci retracements. Okay, how far do they go back to? And what did he find out at the end of doing 300 of them? All right, 91% of them retraced to the 618. All right, now how would you use that? All right. So you've got fibs coming in here, right, like this, all right? 3 fibs, actually 4, 214 down here too, all right? All right, so this is the 214, 382. On top of that is the 50, then 618. Actually, there's another one up here, 786. All right, 91% went retraced back to the 618. So you get a movement like this, and then all of a sudden it says, we're out of seller. Where are we going? 91% we're going to the 618 fib. Right? Where would I put my sell limit? 91% of the time, you'd put it at the 618 fib. See, that's how that information then gets turned into a methodology that you can use. All right. All right. And you say, well, yeah, but what if it turns down here? Then you don't get it. You don't get the trade. All right. All right. What if it turns into 214 and goes down? You don't take the trade because you have no reward for risk. The 214 has no reward for risk. All right. So you never trade the 214. But if it comes up to the 382 and turns, you'd be interested in that. Or comes up to the 50, that's a 50% discount. You trade that. But 91% of the time, they're going up to the 618. Right? See that? That's the data you need in order to become a trader. Right?